Okay, so you want to own a battery storage park. You've seen the numbers. Solar farms flooding the grid with cheap electricity at noon, prices collapsing to zero, sometimes going negative. Then evening hits, everyone turns on the air conditioning, and wholesale power prices spike to hundreds of dollars per megawatt hour. You do the math. Buy electricity when it's almost free. Sell it 6 hours later when every utility in the state is scrambling for megawatts. A 100 megawatt facility cycling once a day, capturing a $60 spread that's over $2 million a year in pure arbitrage. And that's before ancillary services, capacity payments, and emergency grid reserves. Simple. It is not simple. A battery storage park is not a power plant. It's an algorithmic commodities trading desk, except the trading desk itself is made of lithium iron phosphate cathodes that physically degrade with every single trade you execute. Every cycle that captures a profitable spread causes irreversible chemical damage inside the crystal lattice of the battery cells. Lithium ions get trapped in microscopic cathode fractures, capacity fades, and with every percentage point of capacity you lose, you're accelerating toward a $15 to $25 million module replacement bill that your financial model budgeted for year 10, but aggressive cycling just pulled forward to year 5. Here is where most people stop thinking. There is not one type of battery storage operator. There are two fundamentally different business models. The fully merchant operator is the pure trader. No long-term contracts, every dollar depends on wholesale price volatility and the skill of the dispatch software. Merchant operators retain 100% of the upside during heat waves. They also absorb 100% of the downside when mild weather compresses spreads to nothing. Banks demand 40 to 50% equity. The cash flows are too volatile for infrastructure debt. The contracted tolling operator is the infrastructure landlord. A utility signs a tolling agreement paying $7 to $10 per kilowatt month. The utility takes the trading risk. The battery owner collects a steady check. Banks lend 65 to 75% at infrastructure-grade rates. The return is lower, 7 to 9%, but predictable. The choice between these two models determines your capital structure, your degradation strategy, and your entire relationship with risk. Now let's talk about what you're actually building. The batteries are not even half the check. A standard 100 megawatt, 400 megawatt hour facility costs $100 to $120 million all in, $250 to $300 per kilowatt hour installed. The battery modules cost roughly $45 million. That's 45%. The other 55% is everything you never see. Power conversion inverters, $12 million. High voltage substation, transformers, and switchgear, $15 million. Liquid chilling HVAC and fire suppression, $8 million. Interconnection deposits and civil engineering, $12 million. Development, legal, and permitting, $8 million. And none of this accounts for the scarcest component, the grid interconnection queue position itself. With transformer lead times exceeding 24 months and FERC queues backlogged 3 to 5 years, an approved grid connection sells for $100,000 to $250,000 per megawatt before a single battery is purchased. The queue position is worth more than the lithium. Here is the paradox that governs every battery storage park on Earth. Picture two identical facilities. Same batteries, same software. The first operator cycles aggressively twice a day, chasing every spread. Gross revenue is high. But the cells degrade at 4 to 6% per year. By year 5, capacity has dropped 20 to 30%. The warranty is voided. A $15 to $25 million module augmentation arrives 5 years early. The second operator runs conservative dispatch, 1 cycle per day, cherry-picked windows. Degradation holds at 2% annually. The cells last 12 to 15 years. The augmentation bill gets pushed past year 10 when replacement cells are projected to cost 30 to 50% less. The battery that trades less aggressively delivers a higher lifetime net return. The inactive standby position often generates more net profit than the hyperactive trader. Insurance alone costs $1 to $2 million per year. After a series of thermal runaway fires, insurers repriced battery storage entirely. Some underwriters refuse to quote new projects altogether. Grid operators are deploying real-time co-optimization algorithms that compress the manual trading margins early operators relied on. 15 gigawatts of installed storage now chase the same 4 to 6 gigawatt pool of ancillary demand. And capacity accreditation is shifting under the entire business model. Regulators are reducing reliability credit for 4-hour systems under new slice-of-day frameworks. demanding 6 to 8 hours for full capacity payments. A facility built for 4-hour arbitrage may see its capacity revenues cut in half, not from operational failure, but because the rules changed. In January 2025, a thermal runaway event erupted inside Vistra's 300-megawatt Moss Landing facility in California. The fire escalated for multiple days, triggering evacuation orders for 1,200 residents. Vistra determined that recommissioning the adjacent 100-megawatt Phase 2 unit was economically unviable. Hundreds of millions in stranded capital. In Texas, a different collapse. After Winter Storm Uri in 2021, batteries earned extraordinary emergency revenues. A gold rush followed. Within 4 years, the installed fleet surpassed 15 gigawatts, but total ancillary demand is only 4 to 6 gigawatts. Revenues collapsed from $149 per kilowatt year in 2023 to under $20 in 2025. An 86% crash. Ancillary services are a transitory gold rush, not a 20-year business foundation. Let's slow down and actually do the math. 100-megawatt facility, $100 million capital expenditure, $60 million in senior debt at 7.5%, that's $4.8 million per year in debt service, $40 million from equity. Annual gross revenue $15 million, $8 million from arbitrage, $4 million from ancillary services, $3 million from capacity payments. Now subtract charging costs plus efficiency losses, $3.5 million, insurance, $1.2 million, land and taxes, $800,000, trading software, $1.2 million, augmentation reserve sinking fund, $2 million, total operating expenses, $8.7 million, net operating income, $6.3 million, minus debt service of $4.8 million, net cash flow to equity, $1.5 million. On a $40 million investment, that's 3.75% cash-on-cash yield. Less than 4 cents of every revenue dollar reaches the equity investors. In the optimistic scenario, a summer heat wave drives extreme prices. The battery captures 10 to 15 days of 4-figure spreads. Gross revenue jumps to $24 million. Net cash to equity reaches $9 million, a 22% return. In the bad year, mild weather compresses spreads. Markets stay saturated. A cooling pump failure triggers a 3-week outage during peak summer. Revenue drops to $9 million. Operating expenses stay fixed at $8.7 million. After debt service, the facility burns $4.5 million in equity cash. No fire, no scandal, just a mild summer, a saturated market, and one mechanical breakdown compounding quietly over 3 weeks. The difference? $13.5 million in a single year. The next time you drive past a row of white shipping containers behind a chain-link fence near a transmission substation, humming quietly, blinking status LEDs, connected to the grid by cables thicker than your arm, understand what you're looking at. It is not a passive green monument that prints money from sunshine. It is a financial options trading desk whose machinery degrades with every trade it executes. The winning operator is not the one who cycles most aggressively. It's the one who balances cycling revenue against degradation curves, debt covenants, and an augmentation reserve that must be funded before the cells physically fail. The batteries are not the business. The batteries are depreciating inventory on a ruthlessly algorithmic trading floor where discipline, not aggression, determines whether a $100 million bet quietly compounds wealth or quietly bleeds it away.